Good afternoon. Welcome to Reality Bites with Nikki Connors, looking behind the headlines at the moment. Now, of course, if there's something that is going to definitely put you off your lunch, it is interest rates. And I'm sorry that I'm going to be talking about this, especially when we are I'm always so positive about property. So let me first of all introduce you to my guest this afternoon. Brenda Murney is a very well-known, very respected mortgage broker. She's been working with my clients for over 12 years, I think, 11 or 12 years. She's with Vega Lend. She's won lots of awards for mortgage brokering. She's considered one of the top in the country. And I think it's really important, and I've always said this, that we have independent professionals that work alongside us, because it means that everyone is working on your behalf and there is no other agenda that is attached to that. So I'd like to welcome this afternoon from Christchurch, I'm in Auckland, Brenda Murney. Hello, Brenda.
Hi, how are you? Thanks so much for having me on the call.
That's okay, and especially since we spend so much time talking to one another about this exact topic, and I think my whole life and my dreaming life is around interest rates and what's happening in the property market. And I'm sure you're the same at the moment, because I think you've got a lot of settlements coming up as well, haven't you? Especially for our clients.
Absolutely. Look, we've been working together over 10 years.
Oh, it's over 10. Okay.
Yeah, makes it sound like a long time, but a very successful time too, for a lot of people, and so many repeat customers. And I think it's a credit to your business as well. The amount of people that come back. So, it is huge. And I think it's this busy time of year, and developers and everyone just want to quickly settle before Christmas. So, look, it has been a busy time of year. And interest rates, of course, is always on my mind.
I bet it is. I'm giving you as much of a headache as me. But let's just start. I want to put this into perspective, because I say this a lot when I am talking. I've just done, with you actually, a seminar in Christchurch, and it was talking to first home buyers as well. But we've got to put everything that we're going to today in perspective, which is the fact that when I bought my first property, it was 21%. Yes, that's how old I am. And when I started Propellor, it was 9.7%. And that did not stop the demand or the appetite for New Zealanders for investment property. So even though we have seen over the years probably about a 5.5%, which has been an average interest rate over that time, don't you agree, Brenda? I mean, this 2% and 2.5% is really an anomaly in the whole history of property, whether it's your home or property investment.
Oh, absolutely. I mean, we were in a crisis. We were going through COVID and we had 2% interest rates. So it's not reality to think that interest rates are ever going to stay that low. I think we would all have loved that, and we certainly got used to them being so low. But the reality is it's never probably ever going to be like that again.
No. And that hasn't stopped people through the centuries, and New Zealanders are very much part of that. That sees that property and property investment is still very much part of their investment strategy and their portfolio going forward. And I think that before we get into the topic of interest rates, and by the way, it's not such a bad thing at the moment, I've got to say. There is light at the end of the tunnel. There is, over the horizon, there's something to be looking forward to. But when it comes to the important parts of your life, which is the fact for most people it's having a mortgage and paying off their home mortgage, or having a passive income in the future, property investment has to be considered part of that. And so when we look at the advantages of property investment, you and I were just talking earlier, Brenda, and we were looking at a typical New Zealander and the sort of mortgage that they've got and the sort of interest rate and what they're going to be paying and for how long and how much that was going to cost them with bank interest. Do you want to just quickly go through those calculations that you and I had?
Yeah, sure. So we looked at someone with a mortgage of $450,000, and we looked at an interest rate of today, which was 5.89%, and we had someone paying their loan off over 20 years. So that's a weekly repayment of $737. But what the scary part was, over the 20 years that they'd had that loan, and we have worked it out on 5.89%, you're actually paying the bank over $300,000 in interest in that time. So that's a lot. That's massive. And I think people don't think about it. We just get the loan and just, get very relaxed about it and think, oh, great, we've got the loan. And they're not thinking ahead about actually, well, how on earth can I reduce that cost?
And that's right. And when we look at property investment, of course, we're saying that it's long term. We always say that it's, so it doesn't matter at the moment if we're reading in the paper that interest rates, that the property values have gone down by 7% or 6%. Remember, that's 7% or 6% of 27%, or in Auckland, 30%. The reality is that property will continue to grow every year in a solid rate, and we always say that it takes 12 years to double, which is about 6.5%. So we've got to put that in perspective as well. So you look at that interest rate at the moment, and you look at that typical loan of $450. If you're 50 years old or you're 55 years old, that is 20 years. So you are going to be still having a mortgage by the time that you retire. And I find that really quite frightening, and that is so many New Zealanders. So when you look at what one investment property can do for you, so let's just say you sell that property in 6 years' time, and we're assuming that the property doesn't double for 12 years. So if we've got a $500,000 investment property, in 6 years' time, that's got a potential capital gain of $250,000. And so that $250,000, if you sold that investment property, put that into your home mortgage, there's half your mortgage gone. And if you're 50 or you're 55, that means that by the time that you're 65, and just on that one property, you've got, you're working towards having your home mortgage paid off in full. And I think that's really important, isn't it, Brenda, to look at what the positives are before you even look at a passive income, because so many New Zealanders do have a mortgage. You are looking... Sorry.
Yes, sorry, you're right. You're exactly right. And I think it's just an easier way of getting ahead. And in 10 or 12 years, if it doubles, how on earth would you save that kind of money? Like, I just don't think you would. So it's just something on the sideline of all of our businesses, all our jobs that we do. And it's just another form of investment, and it's absolutely going to help us to be, successful, for when we are retired or older, not a good word, but, it is just something that we do need to plan ahead.
Yeah, and I think the thing too is that it is a business, and this is why when we do these education and we're talking to our clients and this mentoring and we're working alongside professionals like yourself, Brenda, any business needs to have the ability to change with changes in the marketplace, the ability to look at how they've got buffers in place, and to look at a strategy that does have to change because they can't, you can't legislate for outside influences in that respect. So that's why we say we look long term. And at the moment, I have to smile as well, because those old days where investors would come and they would say, what is the return? What's the return on this? What is the level of, what percent am I going to be getting on this property from the rental? And that is not the issue. You miss the point completely. When you're starting out and you've got your first or your second property, it's not about the return you get today. And let's face it, you're not going to get a return today. What it's about is capital growth, because it's capital growth and that capital gain that's going to allow you to get another property or to sell that property and work towards paying off your home mortgage. So let's look at some of the reasons why people don't, why they're holding back, and why they're saying, I'm going to wait till next year. And we hear that a lot, don't we, Brenda? So let's look at some of the reasons that you give to purchase now, and I'll go into some of the reasons that I give, and I know that they're going to cross over.
Yeah, sure. So I think, look, a lot of people are quite scared about making the wrong decision. And I think the key thing really is, not making a mistake and buying the right property. And you don't want to lose money. You do want to gain, over the longer term, medium to long term. So, I think it is key about the type of property. But, every time I buy a property as well, and I've got a few investment properties now, I feel nervous as well. I do feel like, oh, is this the right thing? It's just a natural feeling. But I think, you do need to look at trusting professional people to be able to guide you on these types of properties as well. Getting advice from the likes of companies like yourself and Propellor, talking to an accountant, that kind of thing. I think we do need to look at all that kind of thing as well. But I think, it's just a feeling people have, and it is just worrying about the mistakes.
And of course, they talk to friends and family, and they talk to people that really have no idea themselves. And I get clients saying, well, this is happening, or I've heard that's happening in the market, and it's like urban myths. And I go, where? Tell me, who has said this to you? What is their background? What is their experience in being able to give you that understanding? And we had someone recently that their relative had said that there's no growth in Christchurch. They lived there 25 years ago and said there's no growth in Christchurch, and I almost fell off my chair laughing, because when we see how some of our clients have purchased house and land packages from us 18 months ago, and they're clients of yours, Brenda, as well, and they paid $589, $590, and they're now worth in the 800s, and that's not going to slow down. And of course, we've got some of the, with the likes of Christchurch, it's so undervalued because of the demand and because of the growth. It is quite dangerous to listen to people that don't understand. I bet you're as frustrated as that as I am.
Oh, absolutely. And I think Christchurch is a really good option for people to buy in. You can get, 2-bedroom townhouses in the low 600s, sometimes less. And I think, just jogging back my memory to when you started recommending people buy in Rolleston. Now, back then, I mean, you couldn't even, the developers there, the building companies, even the sections, there was just hundreds of them available. I mean, it was just people going, why would you buy there? And you started recommending people bought in Rolleston. And I think you could buy them for about $500,000 a house, a 4-bedroom house. And they've really, really taken off out there. And in fact, it's the fastest growing town in New Zealand.
That's right.
And it was where you said to buy, and everyone was saying, don't buy there.
Well, that's why you come to the experts on that. The other reason, of course, is you wait another year and you're waiting to see what the interest rates are going to be. In that time, you're also going to, while you're waiting for that 0.5% or whatever it may be, and not too sure where it's going to go, in that time, you're going to see with brand new property growth. You're going to see that the costs are going to continue to rise. And why is that? Because building of properties is going up, the building materials by 18-20%. The cost of land is going up. Council costs are going up. Labour is going up. I mean, we cannot legislate for the cost of materials, because a lot of those materials do come from overseas as well. And of course, we're now starting to see that there are people coming back into the country. And that has become quite pronounced when you look at, and we look at Auckland, for instance. Now, I know, Brenda, you and I have both got apartments in similar developments. And talking to the property management companies, because now that demand is coming back, that they're now increasing rents. As old tenants go out and before new tenants go in, rents are increasing by $50 a week. So you wait a year and you may say, well, there is that opportunity of not paying as much as an outgoing. But in reality, what have you lost in that potential capital gain as well? So, and you've lost a year, and especially if you're in your 50s, of building up that equity to in that investment property to be able to sell in the next 5 to 6 years. And we say 5 years because with brand new property, you sell that in 5 years, and you don't pay tax on the capital gain. So you've lost a year of that potential capital gain and all of that interest that you're continually paying to the bank. So the key factor, though, for a lot of people at the moment that's holding them off are interest rates and how much they potentially have to top up a property. So let's go back and look at this main barrier to starting that investment portfolio. And let's actually look at what it means and where we are in the market at the moment. And I think the latest thing that's come out from Tony Alexander, Brenda, if you want to go into that. And this is something that I have said, and I put myself out there, and I agree with him, and I believe that interest rates, they may go up a little bit, but we're seeing the top end of that. So what's your view, and do you agree with Tony?
Yes, well, that's right. So I think the biggest barrier, as you say, for people buying properties at the moment is the interest rates and the costs, and it's putting them off. But we are in an unusual kind of hike with all the interest rates. But interestingly enough, Tony Alexander sent out a report yesterday, and he seems to think that interest rates are actually peaking now. So hopefully we won't see any more actual fixed rate increases. I think he was a bit surprised to see the banks put up their rates 0.5% already last week from the OCR increase. I mean, we know the floating rate will go up, but I think he was quite surprised about the fixed rates going up. I just refixed one of my loans this morning, actually, and it was I was still offered the 5.89% for 1 year, even though the bank rates have gone up 0.5%. So I think it shows that there is actually quite a lot of fat in the tank, so to speak, from these banks with these rates. But just to recap on a few things that Tony Alexander had in his report, and the reasons why he thinks we've peaked with interest rates and what we're seeing. He's saying offshore inflation is falling, oil prices have declined, shipping costs are going down, annual inflation rates have fallen in the US and in Europe. So he seems to think that there's a good chance we'll see these interest rates start to fall in the middle of next year, that we are at a peak. And still popular, and I'm finding the same as well, is most people are just fixing for the 1 or 2 years at the moment, because rates will come down. So everyone wants to hedge their bets and be on the lowest rates, right? So I think really following his advice and other economists, we may hopefully have seen a peak in the market with these fixed rates.
And I think that's one of the things that we're doing in our cash flows for our clients as well. We're allowing for the fact that there may be some lag in this. So we're looking at the 2-year rate at the moment for our clients, and then looking to go to that floating average of what we were saying, which is potentially around that 5.5%. But that was something that I mentioned as well in a number of articles and things that I wrote and spoke about, which was the fact that we do seem to follow the US, and we saw that it was mooted that the interest rates would go down, inflation was going to be under control. I think that a lot of this is fed by the press, because you look at COVID and the scaremongering around what the prices, how everything was going to fall with the prices of properties. And of course it didn't, it went up. We look at the global financial crisis, and once again, that was doom and gloom around the world, and that was all about property. Everything about that was property. And yet we started to recover, and we bounced back within 14 to 18 months. And of course, if you've got property, investment property or your home, remember, you only lose if you sell it at the wrong time. So you're buying something now that we're seeing that because of the cost of building going up, and even though there's a slight decline from 27% or 17% down to 10%, it's still a greater growth than we've experienced since 1991. That if you keep it, you're not going to lose. I think this is something, isn't it, Brenda, that when you hear feedback, well, I've lost 100,000 or I've lost 50,000, you haven't lost that because you haven't sold the property.
No, that's right. I think it's all about when you sell. So that's just key. I mean, we've got, you don't have to worry about what's happening now in the next year. It's a longer term view, isn't it, Nikki, as we say all the time, but it is just about selling at the right time. And another thing, like the building costs aren't going to go down, as you say, so it's never going to become really, I don't think, cheaper. But we are seeing some of the developers offering a few more perks lately, so it does seem a good time to buy, I think. And there's just a bit more availability, and you can. I think there is some actually really good deals out there at the moment.
Yeah, and I think it's the same thing, that to keep the building industry and the developers keeping moving, they want to do something to stimulate the market. But just coming back to that, so there's the fear of interest rates, which means that there is a fear of what, as an investor, you have to top up that investment property going forward. Now, I mentioned that in our cash flows, we look at a 2-year rate, which is at the moment 2 years fixed, and then we look at what history has shown us, and we use that going forward. But when we're saying that the 2-year fixed rate is in the what was that, Brenda, about 6.29? Is that right at the moment? 6.
Yeah, I think that's what you had in there. But I mean, it will be interesting to see if the banks are charging those kind of rates for 2 years or not, or they just.
No, but we've got to be conservative.
Yeah,
that's right.
And you put them in at that, but that seems probably high. So you're being very conservative. Yeah.
And also with rentals, one of the things that as we've always said, that once the borders open again, and we're already seeing that in central Auckland, we're seeing this coming up also in the likes of Hamilton, and we'll see Christchurch start to catch up with their rents as to the increased property prices. But one of the things that is holding people back is the fact that what they have to top up. So even though I'm using the 6.29% for 2 years, I'm being very conservative with the growth in the rental. So that weekly top-up doesn't look particularly attractive for clients until you recognise the fact that how much am I paying to the bank in interest anyway? And secondly, what can we do to help clients to reduce that outgoing and protect what they're doing? So that's where we work with you quite a lot as well, don't we, Brenda? Because in our cash flows, we make allowances, just like any business, for changes in circumstances and looking at that worst case scenario.
Yeah, well, that's right. You do provide cash flows for everybody with estimated costs like the solicitor, rates, insurance, valuations that might be required, all those kind of costs. And you do make a budget for everyone, which is all part of buying a business, isn't it? So it is important. And then we do look at, house insurance, all those sorts of costs. And then look at, well, what is the shortfall here? What is that based on these interest rates today? And, that can vary between $100 or $300 a week in some cases. So I think it's a matter of looking at what kind of additional buffer funds that I could set up as a loan for customers to help soften that top-up amount, and look at ways we could do that. And I normally set up a rental account, a rental bank account with a like $30,000 revolving credit facility on there. And that can help take care of all these costs along the way. And I just think that the costs aren't going to be this huge. It's just, well, we're in the current interest rates for the next year or so. So it's just a matter of trying to allow for that, so it doesn't interfere too much on our life. Otherwise, people aren't going to want to do it. But it is just a short-term kind of thing. And then we do look at how else we could soften those costs as well for people. Everyone's coming off onto these higher interest rates that have a home loan. And so there are some ways we can look at reducing costs, like making sure you want your loan to be flexible on your own home and reduce down those mortgage payments for the time being.
And we've seen, we've seen that, haven't we, with clients of ours at the moment. You can't look at the investment property in isolation. You look at how a client is set up, and you're doing this really well. We've got examples of clients in the last couple of weeks where with looking at what they're paying for their own home, it makes no difference to that 20 years that it's going to take to pay them off. But with you re-looking at how that's structured, you can be saving them an extra 100 or 200 a week that can be utilised towards the top off of the investment property.
Yeah, absolutely. I think it's just making an allowance for this new business purchase. And, the mortgage repayments are the biggest expense for homeowners. So, we need to look at ways that we can, make it flexible and work for them. And that's the good thing about these loans. You want it to be that you can then increase the payments later on when the rates have gone down, and you can pay your home loan off more aggressively. And let's make sure, you are still on interest only for your investment property loan if you've still got your own loan to pay off. And, there's definitely lots of ways that your mortgage broker will be able to help you, and just look at the structure. It's just good to review everything. Don't just set it up and get that loan and never look at it again. I think we're bad at that. We need to be better and make our life better, and just keep revisiting everything.
And I think what is important as well is remembering that the reason why you've got an investment property is another strategy to get your home loan paid off faster. By paying extra, let's just say you pay extra of $100 a week off what the bank requires on your home loan, that's not a lot. That's not a lot over time, and it really doesn't make a huge amount of difference. But that $100 a week, if it was then put into the top up of the investment property, is going to make a huge difference, because there we're looking at in 5 or 6 years or in 10 years selling that property and making a huge reduction on your home loan for a start. So the other thing that we look at as well is with developers. I mean, we have all the developers that Propellor works with. We are also looking at ways in which we can make that top up more palatable for our clients as well. So between what you're doing, Brenda, and it is very important, and this is why you shouldn't do it yourself. That's why you go to an experienced mortgage advisor who is experienced in investment property. That top up, that buffer that Brenda will get for you that you can use when you need it, if it's over 2 years or 3 years, depending on how your cash flows look, can make a huge difference to the decision that you make on investing in a property going forward. So let's now look at, just very quickly, and we'll have questions and answers, and I'm sure that there'll be lots of questions. But this also brings us back to, with interest rates as they are at the moment, and that they are considered quite high as opposed to the 2%, why would we choose the sort of investment property that we choose? And of course, one of the things that we do with clients is to work out what is the right investment property for them, and then with that investment property, can they actually get the loan, and what does Brenda do to ensure that by the time that they come to settle on that property, that there is going to be a loan in place. So first of all, let's look, Brenda, at you preparing your clients for the time when you're going to get approval for a loan?
Great. Yes. No, so I think the first steps really for a lot of people are to talk to a mortgage broker and actually work out what you can borrow, work out a budget. So we're sort of, if we look at that, that's, one thing. We look at, equity in your property, what kind of income you're on, how many children you've got. And the banks are looking at actually all your costs. So that is what you pay for insurances, your fixed costs, insurances, preschool, home loan repayments, and you need to present this in the best way possible. So that's why I think it's really important to look at using a mortgage broker, because they're going to have you looking at your very best before it goes to the bank. So
those things, of course, Brenda, as you've said to some clients, look, for the next 3 months, because this is what they're looking at, the banks are looking at, these are the sort of things that you should do before we go through to show the bank your figures for 3 months. So some of those are, for instance.
Yeah, so that's right. So sometimes people have a car loan, some HPs, maybe a credit card debt. That's 3 different types of loans. So I'd look to try and consolidate that first. And if we couldn't do it against your home loan, as a top up, and I'd top that up on a short term, just to have that cleared off. There is other companies like NZCU that will do a debt consolidation loan, and one debt loan looks better than 3 or 4. So it's actually about looking good, making sure you've got some really good bank accounts. They're not got dishonors or over your limits, because all those sort of things can affect your rating as well at the bank. It might mean that you can't get the property. So we've got to have you looking like $1 million.
Yeah, and that's not necessarily a big thing, because when the banks are looking at your bank statements and they're looking at the various payments, they're looking from 3 months back, aren't they? So you've got time to get these situations under control.
Yeah, that's right. I mean, it could just be a few months later you're buying a property, but I think it's just making a plan. You really need to do this to get ahead. It's such an easy thing to do. And, it is such an easy way of making money. And if you can get the loan approval from a bank, I just absolutely would, do it. Don't wait.
And coming back to the profile of the sort of property, we are looking at reducing our clients' debt on their own home within that 5 or 6 years. And the reason we say that is, if you've bought new property or property off the plan, you only have to hold it for 5 years before you can sell it and not have to pay tax on the profit. Now, that makes a big difference as well. So in 5 or 6 years' time, if you sold a property that you've bought today, that is tax-free money that's available to you. With an older property, you've got to wait 10 years. Also, with older property, it's a higher deposit that is required. And of course, when your interest rates are as they are, you do not want to have maintenance and repair issues as well. So it's important to have a property that is as pristine as it can be, so that if you are wanting to sell this in the next 5 to 6 years, you're able to do that and actually claw back as much of that capital gain as you possibly can. But we'll go into that as well. We're running out of time, and I think that I'm sure that there are some questions there. Brenda, if you've got some questions that you from some of the people that have been involved.
Been very quiet on the question front from everybody online today.
It's been we've got a big group of people online, so I would say that I'm sure we haven't answered all of the questions that everyone has. I think, though, that what has come out of this is the fact that our belief and the belief of the commentators and what's happening in the overseas markets as well is that midway through next year, we will see the market come under control. And of course, it's an election year next year, and I won't get political and tell you who I think you should vote for, but just remember, as a property investor, some of the advantages that have been offered by some of the political parties. But by waiting, you're potentially missing out on that capital growth. By waiting, you're potentially waiting another a few years past, and that's a lot of interest to the banks to reduce the mortgage on your own home. But I think what comes across, especially at the moment, is that we've got to protect your day-to-day cash flow. We can't have you being stressed with your outgoing. So it is important to have the right professional advice, both from the sort of investment property and from a mortgage broker, as to the interest rates, to the buffer that you have in place. As I said, we're dealing with some of the developers about other ways in which we can help you with that. And what else, Brenda? Last words from you as well about where you think it's important to be focused on and still make a decision to purchase.
Yeah, well, I think it is, everyone is worrying, as I say, about interest rates at the moment, but it's just a matter of getting through this next year. And remember, the banks are actually working out any existing home loans, new home loans on well over 8%. And they're getting a pass in their system at over 8%. So we're nowhere near 8%. And banks think you can afford this on 8%. But our rates are 5 and 6%. So I think everyone is going to be fine. And it is just a matter of getting through this next year and looking at the right type of property for you. For me, I would only buy a new build because of quite a few reasons: tax benefits, healthy homes, for those rules, and the bright line test as well. So I think for those 3 key reasons, it would be my only way of getting ahead and buying investment property.
That's great. We do have one question, I understand.
Yep. The question is, what specific types of transactions are banks reviewing when approving a loan? So just to recap on that, they're looking at your home loan repayments, any other loans that you've got, that could be credit card limits, that sort of thing. They're looking at how much your insurances are, preschool costs, any private school fees, that type of thing. It's what they're looking at. We do make an allowance for how much you spend at the grocery store. The banks did pull away, or KiwiSaver is another one banks look at as well, how much KiwiSaver you put in. So looking for your net income. So yeah, that's what the banks are looking at when they're approving your loans. Not so much how much you're spending on coffee and that kind of thing and going out. They pulled back on that. The Reserve Bank had told the banks off for that. It's not what they said. It's more just your fixed costs they're looking at.
Now, you brought up credit cards as well, and I think one of the things that is a bit of a trap for young players is the fact that your limit is considered your credit card spend as far as the bank's concerned. Is that correct?
Yes, they look at it like it is a loan, and if you have a limit of $20,000 but you pay it off in full every month, they're still going to work it out that you have a $20,000 credit card, because you could use it as a loan. You could just max it out. You could do anything. So they have to factor in the limits. So that is something that we often have to reduce down or even close. So,
but the thing is, you close it and you follow the rules for the bank. But dare I say it, in the future, if you need that facility again, you can go out and apply for a credit card again. I mean, we're not talking forever, are we, with some of these criteria?
No, and I think it's just while the interest rates are higher and it is harder to get loans in the way the banks are looking at things. So, sometimes having a review of your insurances is actually going to save you money, because we're also a bit lazy with doing reviews on home loans, insurances, medical insurance, life insurance, and even our house, car and contents, all those insurances. I've just had a review of mine and saved $200 a month, I think, on our life insurance, and also re-looked at the house insurances as well. The value's gone up so much over the last few years, you want to make sure you're fully insured. So it is a matter of reviewing everything, and you'd be surprised what you can save.
No, that's brilliant. Brenda, thank you so much. I think it does become very clear, and I come back and I say this, and I'm sorry if I repeat myself as I always do, but this is not a real estate decision. This is a business decision. And with all due respect to real estate agents, you've got to be dealing with those people that understand investment property, that are looking at interest rates, that are looking at ways in which they can protect you and your cash flow as you go through this process, and also to recommend the right sort of property. We've got time for one more question, and I think that's come up. Brenda, if you want to read that.
Yeah, it was just someone mentioning about the credit card, saying if you reduce the limit, it's really hard to get it back up again. It is quite hard to get it up, I've heard, at your current bank, but I don't believe it's probably as hard to go online and to a new bank and open a new credit card as opposed to increasing your existing bank credit card. I mean, I think 10 or 20 years ago, 15 years ago, banks were just automatically increasing credit card limits and we weren't even asking for that. But I think they've been pulled up about that these days. But you can still open credit cards at other banks. I think that's easier.
No, thank you, Brenda. Thank you so much. Now, if you want to find out more, and if you want to talk to someone, the team at Propellor are all very, very highly experienced. We've got a small team of consultants that are there to mentor you, to help you through the process, to recommend the right sort of property, and to also be the person that takes you to the right mortgage broker, including Brenda, of course, and the right professionals who are all independent on your behalf. And I think particularly now, when it is so important with the stakes and the potential top-ups and what you may have to pay out in the short term and going forward, that you are dealing with professionals with that level of experience. So we have we put up our contact details. It's very easy. Free phone 0800 81 81 91. That's to speak to someone direct. Or if you want to go to our website, which is propellerproperties.co.nz, or even email us, which is info@propellerproperties.co.nz. Now, I won't see you before Christmas, and I just want to say have a very happy and safe Christmas. And please speak to us now and get ready for the new year, because the next 5 years could mean a great deal to you and your family and your financial situation. And we're here right up until Christmas Eve. So thank you for your time and have a very happy Christmas and New Year.